Imagine controlling $1 million position in crude oil during like a massive global supply shock and capturing all that upside momentum, but never dealing with a single physical barrel.
It's pretty wild to think about.
Right. Welcome to today's deep dive. We are tearing into our source stack to decode the mechanics of CFD buckets. We really want to look past the basics to understand why active traders are, obsessively trading pure price exposure.
Yeah, and we're looking at the structural risks hiding in those trades too. Because when you strip away physical settlement, you fundamentally change the mechanics of market participation.
Okay, let's unpack this. Structurally, since physical delivery is totally off the table, you're essentially just entering a cash-settled contract with your broker.
Exactly. You never own the asset.
Right, so it's like betting on the final score of a game rather than buying a stake in the sports franchise itself. You're only exchanging the difference between the entry and exit price.
What's fascinating here is how that lack of underlying custody removes traditional market friction. Without the burden of locating and borrowing physical shares or commodities, you can pivot instantly.
Oh, like jumping between totally different markets.
Yeah, precisely. Traders can seamlessly short an overextended tech index in the morning and then just go long on gold in the afternoon.
Wow, so you're just trading the momentum of global events without the logistical drag of settlement.
Or clearing delays, right. And because you're only on the hook for that price difference, you suddenly have this massive surplus of capital.
Because you aren't paying the full face value of the asset.
Exactly. Traders immediately use that capital efficiency to multiply their position size.
Here's where it gets really interesting, though. I look at this and see a massive structural hazard. I mean, the appeal of leverage is obvious, but doesn't it just fundamentally distort your risk profile?
Oh, absolutely it does.
Because beginners look at it as an advantage, but you aren't just amplifying potential profit, you're mathematically accelerating your path to a margin call.
Yeah, that accelerated risk is exactly the point. Leverage mathematically magnifies the variance of your returns. So since you're only putting down a fraction of the total position value, say 5%, a mere 5% move against you wipes out your entire margin requirement.
Ouch. So a tiny blip and you're done.
Done. And this is exactly where inexperienced traders blow up. They try to apply traditional stock holding mentalities to leverage derivatives.
Like they just hold on and hope it bounces back.
Right. When a trade goes against them, instead of cutting the loss based on their position sizing math, they widen their stop loss out of pure ego.
Oh man, that's dangerous.
Very. In a non-leveraged spot market, you can bag hold and wait for a recovery. But in CFD markets, that emotional paralysis just liquidates your account.
So what does this all mean when you're actually executing these trades day to day? Because if the mechanics are this unforgiving, the operational costs of holding these contracts must dictate your whole strategy.
Oh, 100%. The cost structures are entirely different based on duration. A scalper's primary enemy, for instance, is the spread and execution latency.
Because they're in and out so fast.
Right. When you're targeting micro movements on a 1-minute chart, the gap between the bid and ask price can eat your entire profit margin if the broker routes orders inefficiently.
Got it. And what about swing traders holding for, like, macro data drops?
Well, swing traders, conversely, have to contend with overnight financing charges or swap fees. Remember, using leverage means you are effectively borrowing capital from your broker to maintain that outsized position.
Ah, and that borrowed capital accrues daily interest.
Exactly. So if a swing trader holds a position for 2 weeks, those accumulated swap fees can easily drag a winning trade straight into the red.
Which makes the technical infrastructure you trade on mission critical. Our sources specifically highlight unified platforms like Monaxa for this exact reason.
Right, because market volatility isn't static, it rotates. A unified platform allows you to aggressively shift your capital from quiet markets to highly liquid ones.
So if traditional equities are chopping sideways, you want the infrastructure to pivot immediately into, say, crypto or inflation-driven Forex pairs.
Yeah, and all from a single margin pool. You need a setup that adapts to the volatility rather than fighting it.
Ultimately, trading pure price exposure isn't a shortcut, it's an amplifier. The flexibility to trade anything, anywhere in either direction is incredible.
But used carelessly, that flexibility just becomes risk.
Exactly. Without rigid position sizing and systemic discipline, it's just a faster way to lose capital.
It really forces you to divorce the asset's real utility from its price momentum.
And that leaves you with something to really chew on. If CFDs allow you to strip away all physical ownership and trade purely on price momentum, how might this renter's mindset permanently change the way you perceive the real-world value of the assets you interact with every day?